Greetings, everybody. This is Jeff Scott, and welcome to this week's top-down review. Today is 12/19/2021, a big day in the Scott household as our dog Boone turns 15 today. He still thinks he's a puppy, which is most of the time a good thing. I called this today, have we seen the market top? But I also put in there, can small caps save Santa? And I'll point out what I'm seeing that sort of brought that title to me. Again, my name is Jeffrey Scott. I welcome comments. Either email me at hgsidoc@gmail.com or under the remarks session. Hopefully I'll remember to talk about my update with Wally, but I don't want to do that first. So let's go ahead and let's get started. So as always, this is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments. I am not affiliated with any software vendor or trading company. Tools demonstrated are those that I use in my daily trading. I paid for all the tools that I use. And trading involves risk, and you are solely responsible for any investment decisions you make. I probably won't go into a deep options analysis, but I do from time to time. And I just want to call out that options are considered by many to be high risk. And before you trade options, please look at the Options Industry Council website and get educated. Not going to spend a whole lot of time here. I call my trading be your own guru. And the whole point of that is I've learned from very smart people. And I think that's what you need to do is you need to identify folks that you think can influence your trading. You need to learn from them and then make it your own. And so to me, I'm an amalgamation of many of the people you see here, from my mentor, Ian Woodward, John Person, friend and mentor, several of the people related to Cancelim. May rest in peace, George Lee, who joined Ian in the bull market in the sky in the last year. Sager from Superior Profit with the wonderful Q tools. And most recently, I've become very intrigued by some of the things that Rob Hoffman's doing, including his wealth chart software. I own a lot of different tools. They're listed here. I use indicators within the tools, such as John Person, Sager's tools, Dr. K's tools. From time to time, I'll bring some of these people here to talk to you in this forum. And as I like to say, I'm never paid by anybody to introduce you. And I'm an unpaid volunteer, and this is just education. My website, what I use, suggests my relationship with Highgrowthcom. And I can assure you that relationship is because I love the program, and that's it. I have no financial interest. But you can see from these programs how much time I spend with that product. I also want to tell you that Wealth Charts is becoming increasingly an important part of my tool set, and that Wealth 365 event, I think, starts sometime, I'm not the greatest on dates, the week of the 13th or the week of the 16th, something like that, in January. I'd look it up because if you like the tool, it's the best price you're going to get. They may offer 4 of those conferences a year, but that's the time to buy it. And he being Rob, saying that the founder's membership is going to go away. Highgrowthcom is the website for HGSI. They give you a free 30-day trial without even a credit card, which is, in this day and age, bizarre. Nobody else does that. And under investing strategies, you'll have hundreds of videos. Where are we on the stock patterns? Well, pretty clear that we've rolled over into stage 4 of fear. The issue is, do we have a long ways to go, or is this just a shallow pullback? Right now, still probably, except for some of the small caps, if you look at the index, a shallow correction pullback. Heck, we had all-time highs within the last week. But, you wonder if this isn't the start of something worse. And we'll look at some of the data, both bullish and bearish. And you got to remember the stocks that are high growth stocks, they go up like rockets and they come down like rocks. So what does that mean? It means that I can tell you I have less positions. I have smaller positions. I've raised some cash. I have bought contra ETFs. Now, a contra ETF might be doing it 2 ways. I could buy SQQQ which goes up when the NASDAQ goes down, or I could short TQQQs. I'd rather short the TQQQs. I get more bang for the buck. I'm short TQQQs. I'm also short some spiders right now. I am not net short with my portfolio, even though I got puts on my Amazon and a number of other my long positions. I will make more money if we get a big rally this week, which we could. Um, but I want to protect myself in case we don't. And I mean, my opinion means nothing except to me. Obviously, you listen to it, but you form your own opinion. I think we're still closer to a top than a bottom. It wouldn't shock me to see another 3, 4, 5, 6% pullback. I know over the last several months that choppiness has clobbered me. It's probably hurt your portfolio some as well. So I'm being a little bit defensive here. And you can take it however you want, but net, I am still long. Look at Friday. Friday sold off into the close. Interestingly, small caps were up. Sort of where my comment comes about, will small caps save us? They were up almost 1%. They're up 0.99%. But when you look through this market, all right, Fed tightening, okay, that should mean financials should be rip roaring. Yet every financial except for two here are red. Wow. Defensive stocks should be strong. Staples, not really. Real utilities, definitely not. Real estate, 50-50. And as I look through, materials were weak. Energy's weak. I already mentioned financials. Industrials weak. Staples weak. Technology mixed. Discretionary mixed, but both mixed weak. Interestingly, strength in healthcare. And of all things, it looks like biotech might be stirring off the bottom. So this was not a great week, and it was not a great day personally on Friday. Although, because of my protection, the downside for me was very muted. I just didn't make much money. Major markets tell a story. Let's take a look at them. So I'm going to hit that button there, and let's see if I can pull up what I want. I think I want this. Awesome. And make sure I'm in daily. I made that mistake more than once. So let's quickly look at the futures. I like looking at the futures because it tells me the whole story, perhaps eliminates some of the gappiness. So if you want to be bullish, lower left, upper right, all-time high, because we know that we hit the all-time high this year, and this is the highest in the last 52 weeks, occurred Thursday, okay? Closing high probably occurred on Monday, but Monday, Tuesday, or actually prior Friday. We went above that on Monday and came down. But, how bearish can you be when you're one bar off the all-time high? Well, bad market starts somewhere, but I don't want to be overtly bearish here because you're one bar off the all-time high. More bullish. You've just come down to test the 50-day moving average. This was painful in here in September and October when we broke through. Right now, we're sitting right above the 50. So that could be still in the bullish category. We've eased off some of the extension that we had as we got extended up here. You still have the 17 above the 50. So I look at this, I see a John Person sell signal that bothers me. But right now we've pulled back to the 50, and we're at a natural place we expect to bounce. And you could see that we had a little bit of a tail on the bottom here. So as much as I think this market's got a little bit more pain to come, we're not necessarily showing that. Now we can look here, we have bigger volume on a down day. So do I think the market goes lower? I do. I'm concerned about this market. We'll talk more about that as we go into HGSI and look at the spiders. But we are at a place, and that's why I said maybe we see a bounce on Monday, because we're at a natural bounce zone on the spiders. How about the NASDAQ futures? Now the NASDAQ futures aren't quite as pretty. Yeah, lower left, upper right, kind of, sort of, much less of a high ascent angle than on the spiders. Really sideways now for a bit. You can see the all-time high was reached back November 22nd. So a couple weeks ago, we've broken below the 50, which is worse. And we'll talk more about this also in a John Person sell signal when we get into HGSI. The Dow futures, make sure I got, is, kind of a lot like the spider, except look at the Dow. It's starting to look like the Russell. Why? Because you could almost argue, here's your tops, somewhere in here's your bottoms, and we've had pretty much a sideways move here since May. So we're in the middle of the range between the high and the low here. We did break below the 50. The 17s crossed below the 50. So there's some damage here. All right. Also in a John Person sell signal on the daily. If we look at the Russell, here's the sideways move of the year since February. And, I said maybe the small caps can save us. And the reason why is we had a couple days, Wednesday and Friday, with nice reversals and bottoming bars, and we're getting right down to the lower part of this range of the Darvas box. So of all of them, this is beaten down the most from the high here back in early November with the false breakout that came here, and then the takeout all the way down below the 200. But are we getting near the place that this thing has bounced and make this lead to somewhat of a Santa rally? We'll see. I can be wishful. I'm not short the small caps right here. Anything I had short or any position in TZA or short TNA, I covered because I looked at that and I thought if any market was in a position to potentially recover some, it was that market. But again, it still has a long ways to go. Here is the VIX. Again, if you want to be bullish, the VIX has come off its height. If you want to be bearish, we broke up above the 200 and the 50 here. If anything, it looks like we're heading back up. OBV is heading up. And if you look at where we're starting to base at, it's much higher, and we'll see it on the weekly, than where we were basing when the market was going up. And then the dollar won a rally on Friday. Notice on Wednesday, you had a reversal in the dollar as the Fed spoke, and that led to market rallies perhaps. But you've got really almost a belt hold day occurring on Friday and really engulfing, going back the better part of a week. That's a big reversal. That says to me the dollar's probably going higher, which is not great for my small stock idea. And you can see a John Person buy signal here. So no question that the dollar is strengthening here. Now, as I pointed out before, and let's get back to, let's shut this for a second. If we look at the weekly, you can see the dollar, although it's had a big move up, okay, is really well off its highs. So the dollar's still in the middle of the range. Here was the prior resting on the VIX, and we're above that here. If I go further to the left, you'll see even lower. And then on the other indexes, you can see how far they have come looking at weekly charts. So off that March low, there have been major moves. Expected moves, let's call that puppy up. And I think that's going to be here. Interesting thing on the expected moves. Remember, this is basically buying a straddle at the money, meaning you're buying a call, buying a put, the option, or you're selling a call, selling a put. If you're buying that call and the put, the amount you're paying is about the amount that the market maker predicts the stock will move or the instrument will move in either direction. So if for the coming week, if the at the money straddle is $90 on the S&P, the SPX, that means the market makers are predicting a plus or minus 90-point move. For you to make money on that $90 purchase, you've got to have an outsized move. As long as the price on that instrument stays within the expected move, the market makers make money. And if it's the closer it is to where it opens, or where the close the prior week, which is where the midline is, the more money the market makers make. smartest money in the market are the market makers. And even though it's not supposed to be in the 80s, I've calculated about 83% of the time, prices finished within the expected move. So if we look at the week we had, it was a volatile week. It had a Fed date, and it had a 5-day trading week. It's hard to see here, but you could see the green and the white, the expected move to the upside, which is about 90 points, is actually larger than what the expected move was the prior week. And the crazy thing is there's no Fed meeting this week, and there's only 4 trading days. So the market makers are predicting a volatile week. What did we see on the S&Ps? Here is where it opened, the white line. It traded higher, sucked in people in, and sold off the rest of the day. And then on Tuesday, it sold off, actually traded below the expected move, probably suckered in some shorts and rebounded back in. Wednesday, we had the Fed day right back to neutral. Thursday was like Monday, a sell-off again, and Friday, another sell-off. Now, tried hard, it actually got back in within almost within the expected move. So the market makers lost a little bit on the S&P. So really all the action though, except for this tail on Thursday to the top, was all within the lower part of the expected move. What about the NASDAQ futures? NASDAQ futures traded down, got back to midline on Wednesday, false breakout perhaps on Thursday, and closed below the expected move. A close below the expected move is bad for the market makers, but you also start getting the risk of a gamma squeeze to the downside. So although most of the time it's going to stay in, and you're going to see a move back within the expected move, a big move below or above the expected move can lead to an outsized move because of the way the market makers have to protect their positions. That's the NASDAQ. Look at the diamonds, the Dow futures. Again, all the action was to the downside, closed within the expected move. If I look at the Russell futures, teased us. Really moved quite a bit below the expected move on Friday and closed back in. So sort of a push between the market makers and those that would be buying the options. And then lastly, or the last two, the VIX stayed at the upside of the expected move. So this will be opposite the bullish case for the stocks. And the dollar also stayed within the expected move. So what does this tell me? It tells me all the action on the indices was really confined to the downside or flat to the downside on the week. And I think you know from your portfolio, it was not a very bullish week in the markets. Now, what else did we learn? Well, certain things I find perplexing. One of them might be that rates are falling despite the fact the Fed signals tightening. Is that because the rest of the world is still loose? Well, England raised rates. Is it because the economy is going to falter? I don't know that. You know, the GDP is great. Is it because of COVID? I find it surprising and probably not a good thing that rates are falling despite the Fed saying they're tightening. There's a reason that I have this line here on the bottom. And it turns out that rates are not, low rates don't always signal great things for the economy. High rates are enough to shut down the economy. But if your rates keep falling and gets below this white line, sometimes you got to wonder what's bad out there that we're not seeing. Bad low rates, you'll see weakness in the banks and insurers for a reason. It's perplexing. AD lines and price roll over. Now, a couple things about this chart. Small stocks left, large stocks on the right. You got lower highs on the AD lines. Is this market about to roll over? It's certainly been going up for a long time. If I look at the NYSE, you did take out that prior high here. I don't know if this is going to be a high and we're going to take out the lows, but clearly the NYSE AD line is down. All the major ETFs took a lick down this week. And if you look here, the TLT was the one going up. Why? Because rates were down. Breadth came back down this week. Stocks above the 200, stocks above the 40. Neither of these are in areas like we saw in March of 2020, on other times when the market was just destroyed, and here and in here. But you have seen reversals in this range, so I don't want to ignore the fact that we might be approaching some should be overbought, because sometimes I do this and spell check doesn't pick up stupidity. So that would be approaching short-term oversold. 3-month new high, new low came down as well. Again, an area where you can see a reversal, but look at March 20 and you could see you don't have to reverse from here. And in fact, after some of the original drops in March, we had little teases, and it took a while for this to resolve. So coming back down, this is where the approaching short-term oversold is coming from. The daily McClellan, we continue to have divergences where we had higher highs and not higher highs on the oscillator and the summation index. And eventually, you really start to pay attention to this. And, the yellow line on the oscillator represents an area that the market likes to come down and bounce from. It bounced here last time, went down to the white, which is similar where it did in March. We're coming down again. So again, breadth is deteriorating, nothing different on the weekly. We'll see where we end up. The buckets, take all stocks in the S&P 1500, 62% are below their midline. So that's bearish, but not overly bearish. And you could see most of the stocks are just below the midline. Very few are below the Bollinger Bands or above them. This is not where I see reversals from. Certainly you could see moves up from here. Certainly you could have chopping around from here. But this is not all in because we're going to reverse. December 1st, this is all in because we're going to reverse, when 50% of the stocks in the S&P 1500 were below their lower Bollinger Band and 93% of the stocks were below the midline. So this is not a sign of an impending reversal. You can go up, you can go down, but it's not put all your money in. Respect the Hindys. I think those who follow me for any length of time know I respect the Hindys. And when I see more than one Hindy in a row, I expect at best case a sideways move and typically increasing volatility and sell-off. We've certainly seen that in the NASDAQ and the NYSE as we've come off the highs. But we really haven't seen an implosion in the indexes. You have seen an implosion in some of the soldiers, but it's the generals, the Microsofts, the Apples, the Nvidias, the Googles that have maintained, even the Tesla up until recently. What happens when the generals roll over? You're going to need the small caps to start saving us. Interestingly, Thursday and Wednesday, even with the great market recovery on Wednesday, we saw Hindenburgs occur again in the NYSE. I do not think we're out of the danger zone here, folks. When you see the red highlighted, that means your new lows are up, green, the new highs are up, and in the Hindenburg Omen, they're both up. So the NASDAQ has just sold off. We got it as high as 10% of the NASDAQ stocks at new lows on Tuesday. We've come off that some, but as you see, there's really a paucity of new highs. Market tone, we went from a mixed bullish a week ago to mixed with a bearish tint here. So that's deteriorated. If we look at performance on the week, we'll start on the right. Because I've got so much protection, I had a flat week, 0.38 down. Meanwhile, my buys, which don't have protection built in, was down 0.97, and my filter buys were down 1.75. The S&P 500 was down 1.44. Now, note, I don't make a purchase unless my stocks move in my direction, so it doesn't mean I would have bought any of those. The Canaries were down 0.63, and the keepers list, which I will tell you is gone, dead, buried, was down minus 2.72. I'll talk about what its job was. You notice in the yellow, the IBD 50, the Market Smith 250, and the IBD 85 all were down below the S&P 500 this week. So this was not a great week for growth. Over here you have ERG, EPS rank plus relative strength rank plus group rank. I throw out the head, I throw out the tail, and the reason for that is the number of stocks at this area is very, very small. Okay, but what do you see? You see a pretty impressive performance to the downside as your ERG goes up. Again, I ignore this because of a small number of stocks. I ignore that because of a small number of stocks. If we look at performance on the left versus EPS rank, growth underperformed. If we look at relative strength versus gain, high relative strength underperformed. So this was a very difficult week in the market. Again, protection to the downside helps me, but if we have a rip-roaring move this week, I'll have to get out of the downside stuff very quickly, and that will mitigate some of my upside benefit. If I looked at sector strength, we went from green and yellow to green and red, so mixed to weak. And if we look at the tools in Edge and Q Edge, so first thing is this is the S&P 500, and this is the S&P 1500 sectors. If we look out over a month, you can see we've been in a difficult time in the market where about 80% of sectors industry and a little bit less than 80% of stocks have been down. If we look at Friday, it was closer to 50-50, which is interesting because when you look at what I wanted to look at. Well, you look at this, the market as a whole is actually worse than when I look at a one-day performance. So that suggests to me perhaps that there might be things that are not being measured in the index, the S&P 500, such as perhaps, or the S&P 1500, maybe some small caps, who knows, conjecture at this point. If I look at 2 days, if I look at 5 days, it's been a negative market. You can see the buckets from real-time analysis using EdgeRater. There'll be some differences. It depends on when you update your S&P 1500 list because there are stocks that get acquired. You can see these are the buckets broke down. Dark red is Friday, light red is Thursday, and you can see below the midline, but very few stocks above or below. And if we look over 1 day, we had 3 versus 8, 3 down versus 8 positive. Over 10 days was the one positive thing here. There was 8 positive sectors and 3 negative. But over the month, only 2 positive. And you could see here on Friday, just in case you can't see it, 5 positive, 6 negative on the S&P 1500 sectors. So they will be different than the S&P 500 and include more broad, some of the smaller stocks. If you rank by strength, healthcare, communication, information came up to the top. Real estate was right under that. Notice what's really lagging is financials and industrials. And utilities surprised me. On the week, they were still number 2, but they weakened into the end of the week. In fact, if you look at a 5-day window, it's healthcare, staples, utilities that tell you over the 5 days there's clearly defensive things at work here. If I just stick to my top 3 on end of day Friday, these are their industry groups, and there's 147. So healthcare technology was number 1, probably driven by Cerner, which is being nibbled on as a potential acquisition by Oracle. You can't see this. I don't expect you to. These were the stocks that came out of the top 1, 2, 3, 4, 5 of the industry groups. These are the crown candidates, some of the best, and we'll probably look at Halo. In fact, Halo up here was considered an undervalued stock with good growth. The problem after downtrends is there's lots of resistance above here. So I actually bought some of this off the bottom here, and I will buy more if it can break through resistance here. The one below that is mRNA, is also I thought looked interesting, this whole COVID complex with this new COVID strain, Omicron, showed some life. And Novavax actually got an not EU, but a WHO authorization. So I might look at mRNA as well. Now, this is the QVital tool, which I just love it because I typed in Halo and it figured out what the right symbol was for Thomson Reuters. These are the stocks that are sort of in its family. This is a little bit about the fundamentals, and you can see that we've started moving. The market's been down, and over the last 10 days, Halo's been up 18%. This tells me that it's undervalued. And look at the growth on earnings per share. Pretty impressive. And you can see here EPS and revenue as well. So I thought this was an interesting pick. I looked at seasonality inside QVital, and the seasonality was sort of not such a big deal. There's no great seasonality on this. Average move up is 11.6. Average went up is up 28%. Average went down is 8. It's up 65%. It's not horrible seasonality. Had better seasonality, I would say, in November. I want to talk about seasonality for a second. Many of you commented to me about Magenta Trader and your concerns. Magenta Trader is a product that I used for a long time. We know that the proprietor and the programmer separated, and there were some entanglements there. Many of us had purchased forever data and software or lifetime data and software. We know that Wally purchased the company or was purchasing the company, and I know in my case, Derek arranged for my access to continue. I also know that the website magentatrader.com went dark and is now available for purchase if you so desire recently. So I felt that I was cheated because I paid for lifetime access and data. I got a hold of Wally and heard his side of the story. I'm not a lawyer and I'm not a truth detector, but he sounded genuinely sincere. What Wally explained to me, which don't surprise me, is that the transaction with Derek never was fully consummated, that Derek was not perhaps fully disclosing things to Wally, and recently Wally gave back the asset. According to Wally, the magentatrader.com website, which was turned off, was owned by Derek at the time and not by Wally. Assuming that all that is true, then Wally really does not have any personal or corporate responsibility to us lifetime users, and any concerns we have would lie with Derek. Now, Wally did offer to help us, and so I will put a link in the email and in the remarks section where Wally will, if you can prove you were a lifetime owner, will give you a substantial discount on his package. He used a similar scheme on seasonality, but it's as far as charting goes, but as he made very clear, it's different than what Derek had, and it's not nearly as full featured, but there's a lot other things there. So I leave that to your own decision, and I will put under the remarks on YouTube and in my email a link to Wally's offer. So I appreciate Wally talking to me, and thank you, TG, for hooking us up. I feel better about it. The Canaries, on one hand, they've broken down hard. They've broken through the 50 as the next stop, the 200, and it very well may be, except they stopped right on the 100. So we'll see if the Canaries can rebound. They look to me like they're breaking down, and they lived on the 200 for quite some time. They might just be going back. The keepers list is now officially retired. It is broken down as well. Why do we have a leaders list? Because we want to get the leaders list around here. This is when we got it. And we wanted to ride that, but when it broke down, and truly it broke down here in mid-November, that tells you the market's probably going to follow. And that we look at a leaders list so that we find early evidence of a market that might roll over. The leaders list worked. Say bye-bye. The keepers are now retired. Know your news and earnings. Interesting week. I mentioned that the expected movement range is big. It's $90 on a 4-day week, so it's considerably wider than last week's Fed week. Strange. There's a lot of economic news that comes out on Thursday. Markets are closed on Friday. Awesome, awesome, awesome. I have a day off. We'll see if I actually go to see my new granddaughter. With COVID, we may just stay home. Judgment call to hold stocks over earnings dates, bad judgment to not when your earnings date is scheduled. Lighter week of earnings, but look, you've got CarMax, big stock. You've got Micron, and then it'll be interesting to hear from Carnival and Nike on if something is going on in I think that's Nike. I don't think that's Adidas. It's just out of touch with society I am right now with COVID, but we'll see what they have to say about the reopening. So prior week closed a record high. This week, the market was down. NASDAQ led to the downside, 3%. Fed left things intact on the interest front, but doubled the reduction of asset purchases and signaled 3 rate hikes. So that actually did not surprise the market. The market actually rallied on Wednesday. That was it. Was it short covering? Was it Powell not as hawkish as feared? Whatever, but the markets fumbled that rally over the next 2 days. Defense was up on the week, and I said for over 5 days, healthcare, real estate, staples, utilities. Tops are a process. One certainly gets feeling we may have seen the highs for the year. And with the Fed signaling tightening, resurgence of COVID, talks of shutdowns worldwide, I think the risk is to the downside. However, as bearish as I feel it is, or I want to be, it's important to point out that we're entering a period of strong seasonality into the new year, and we still might see Santa Claus. I continue to prune my portfolio, taking losses to reduce my tax burden, and yes, I have some losses this year, like most of us do, and reducing positions and raising cash. As I mentioned earlier, I put back some of my hedges, but I'm still not long. I think we need to heed the Hindys and recognize that job one is protecting one's capital. That's why I'm willing to give up gain to protect downside. And in times like this, I'd rather miss another 5% rally than digest a 20% correction. And remember, as Ian taught us, high growth stocks may go up like a rocket, but they fall like rocks. So I'm going to go into wealth charts for a second and show you something that might temper my negativity. So this is what I call our Guppy Charts. And a lot of people use these charts. And they're kind of interesting to me. Let me play this here. All right. These are a series of moving averages. And for the sake of my quality of life, I didn't do as many as I've done in HGSI and others. But every 50 periods, these are daily charts, so 50, excuse me, every 25, no, it's 25, 50, 75, 100, 125, 150, 175, 200, up to, I think, 250. And you'll notice during a strong market, remember 50 is free parking, a market runs up either above the 50 or on the 50, and that we look for periods of time where it might break into the moving averages, so that might bother us some. We look for times when the market's so well that the moving averages flip and the short-term moving averages become on the bottom and the longer term on top, which is not ever fun in our portfolios. And the big fear is we want to avoid this, which was the March 20th come down. If I go through and I look, most of the pain that you felt in the market has always happened when it's broken either into the moving averages or below. When you're happy and making money, it's because it's riding above the moving averages. And you can look here in 2015. I believe that was when you had the, what do they call that? The taper tantrum. And, you know, good times may pierce, come right back up. But if we go back, I just want to show you 2009 as an example. I think we're there. You can see you can get prolonged periods where these inverted moving averages now act as resistance and no longer support. Now, for me, when I move back into those moving averages after a downtrend, I'm interested. When I break above them is when I start to go all in. So where are we today? Let's go back and look at this. So today, we have been running up on the S&P as a spiders. We had a little period in October where we went in. We are still above everything but the 50-day moving average. That is a bullish posture. I'll be watching this close, knowing that if I pierce a couple more of these moving averages to be more concerned. But this does not look anything like this, which was March of 2020. And notice how it moved in very quickly. So I'm going to watch this like a hawk, but that is the spider. When I look here at the diamonds, diamonds pierced it, came right out. Diamonds don't look much different today. Now, is this a one-week wonder we're going higher? It certainly could be. The point of this is, as bearish as I may feel, this market has not given up the farm yet. And, you know, you got to wait for the market to roll over. Don't listen to me or anybody else and tell you what's happening on Monday, Tuesday. We don't know any more than you do. Again, we haven't broken down here on the Qs. The one I'd be most concerned about would be the Russell. And you can see the Russell has broken down. So this is the pattern we don't want to see. And it calls out the weakness in the Russell. But interestingly, all that's really happened here is the market's gone sideways for quite some time. The moving averages came together. So I'm not even sure what it means. So my Guppy charts tell me ain't over. Other thing I like to look at is I like to look at ratios. Here's your spiders going up here. And I'm just using a line chart. This is a daily. You can see the pullback on Friday. This is the 50, and that's the 200. If I look at the spiders versus gold, spiders have clearly outperformed. Gold was a little stronger on Friday as the market sold off. All right. How about spiders versus bonds? If I look at times when the market really has a problem, you'll see this break down. Now we broke down below the 50, but we really haven't given up the farm. I'm going to watch that one closely. How about spiders versus broad stocks? Spiders are still leading versus the equal-weighted RSP. So why, when it's up here on this side, it means the big boys have done better. Interestingly, off the March bottom, that's not exactly what we saw. Off the March bottom, we did see some strength. See if I can get some of that. This move down here occurred immediately off the March 2020 bottom, which meant the general market was doing well, not just the generals. I can look at spiders versus FANG, and we know that FANG has done well up until recently, and the spiders have underperformed FANG. But if you look at over here, down here, spiders versus the IBD 50, spiders have outperformed the IBD 50. So the big generals have outperformed the spiders, you know, Facebook, Amazon, Netflix, Google, Apple. Yet the IBD 50 ETF, which are small cap growth, is underperforming the spiders. Here I'm looking at another way of the similar thing, the ARC Innovation Fund versus the Qs, way underperformance. So the Cathie Wood small cap growth, speculative, versus the large cap growth QQQs. Cathie's getting slammed. Here is IWB, which is big cap versus small caps. And we can see it's still a big cap leading small caps. And over here, if I look at the Q versus the equal weight NASDAQ, again, the large cap technology stocks are way outperforming the equal weighted technology. So I get a little bit of a story of the market there, and it helps me understand. One day I'll probably do a program that's very heavily into this, but this to me is still an HGSI presentation. Don't need to look at TradeStation because I'm not expecting to see anything that's in danger of the high jump. So very quickly, flipping to HGSI. And why do I talk so much about the market? Because it's all about the market. Here is the spiders. You can see the weekly, how beautiful it's run up. and you can look at the daily. You got a person sell, a mobile breakdown. Your weekly kahuna turned red. Here's your recent Hindis, which are calculated on the NYSE, person sell signal, and a kahuna to the downside. Right now you're sitting on that 50, and I guess if you want to be bullish, you better hope that we bounce off of this, because right below that in green is the chandelier stop. A breakdown there. Do you go down and test the 200? Boy, that would hurt. Perhaps a 43.50 to 70 is not out of the question. That would be another 5% decline. Now, Ian always told us to think about a high road, a low, and a low road in an intermediate rate scenario. I mean, clearly the high road is up to new highs. I don't think that's likely, albeit it's certainly possible. The low road is clear. It's down at 200, and hopefully you bounce, or do you keep going? And then I think the intermediate road, which is the one that's probably the most likely, is do we chop around here for a while and then declare? So I got to be prepared for those scenarios. I don't feel strong that it's going higher. Even if we get a bounce, I'm going to be thinking it's a trap. So I've positioned my portfolio to benefit some if there's a pullback and to reduce the damage if it goes higher. So that's the S&P. If I look at the Dow Jones Industrial, and this is all over the place. Hard to say much different. It's also broken below the 50, right at its chandelier stop. Again, these are the cash markets. If I look at the Russell 2000, you know, if this one shows, because we've looked at it enough, I've got to find it, don't I? Up here at the top. But the Russell, you know, I mean, if I'm not the world's best line guy, I'm going to make this a thick one because I do think that this is a thick one, not a thin one, meaning there's a little bit of a range. But that's the bottom of the box, okay? Take it the other way. There's the bottom of the box. We're at the bottom of the box. If we're at the bottom of the box, somewhere over here is the top of the box. What do you think the scenario is here? Well, I think that it is very possible we do this. Of course, it doesn't look like that. It'll look more like this. But I do think that if we're going to get saved, this is at a natural bounce position. A breakdown here, God knows where we're going. Okay. 200. All right, not out of the question. And then obviously the neutral position, which is always something to think about, is it just continues to bounce around the bottom. You know, we've been going in a sideways move since February, and a test of this line has led to the market going higher. So I got to err on that side. So I might be looking at some small caps if I really wanted to go long this week. I don't really want to go long. Just to let you know, I'm concerned about this market, which I think is probably quite obvious from how I'm presenting. I hate it when it doesn't do this in alphabetical order. Sometimes it does, sometimes it doesn't. I've used this program forever, and someday I'll actually figure out how to do that. The NASDAQ has broken below the 50, but it actually finished higher from the open. This was a big open down and reversal day. Does that lead us higher? I don't know. To me, it's in no man's land. It's below the 50, above the 200. It's got chandelier stop up here in the PSAR dots. It's got a lot of overhead supply to get over. I don't think that's an easy one. That could also be a sideways move. Now, there have been some changes. I talked to some friends last week about maybe biotech. Biotech moved. Did it move a lot? Nope. But look at this weekly bar. And why was I thinking biotech would move? Because look at the week before bar. A big handle came in. If you look at Friday, you had a mobile breakout from the squeeze. You had person buy signals, pocket pivots, and kahunas. If you look at one of my favorite things to look at, divergences clearly going down, and look at John Person's wonderful market catcher clearly going up. So you got convergence, a bunch of buy signals on something that's been more beaten down than it's been beaten down in years. I think biotech looks interesting here. Now, the problem with biotech, overhead, 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 overhead. A lot of people, if it just comes up, I can get out. So I don't know how fast it's going to go up. It's going to have a lot of resistance. I will tell you that under here, you got this green line. They actually flipped the chandelier to a buy signal. So we'll have to see what the NASDAQ biotech does. Keep in mind, you could play Labu, okay? All right, that's one of them. That's what I usually play. Sort of looks like it's coming off the bottom. Doesn't look as good, though, as the NASDAQ biotech. I can look at IBB. That one might look more like the NASDAQ biotech because that's kind of what it is. So not all the ETFs are the same, and it may matter which of the COVID drugs, or COVID companies they have in it. If you think about last week, what was my top stock to buy? It was Pfizer, so not biotech, but certainly in the healthcare space as well. Now, Philadelphia semiconductors have been big leaders, but they're rolling over. Now, is this just a one day? Unlike everything else, you want to be bullish, be my guest. Why? Because where I had overhead supply, I got support. I got chandelier stop and PSAR dots. I got the 100, I got the 200, and I don't, in this scenario, have a ton of overhead supply. So I would be totally okay with owning some of this, but I might want to see it get back up into the bottom of the box. You look at Nvidia, you know, sort of the story of semiconductors. Nvidia, which has been just a great stock, has pulled back. Now, is that a great buying point here on the 50? Could be. It's worth watching. But the weekly bongo turned red. It's below the chandelier stop, pocket pivots, kahunas to the downside, and a person sell signal. So I would be careful with it. And then what else would I say? The other one was AMD, which is another leader in the space. And you can see even AMD has pulled back to the 50. Now, buying opportunity, maybe, but it all depends on what Mr. Market does. If the market goes up, both those stocks are likely to be good ones. I think the market's going down, though. What else could I look at? I mentioned how bad ARK was doing. I don't have a problem with Cathie Wood. I don't even know Cathie Wood. I could care less about Cathie Wood. Well, look at what ARK is doing. ARK bounced on Friday. Remember, small caps did well, so maybe this will be your season. But boy, lots of overhead supply, and the 50 is below the 200. I think she's got her work cut out for her. Now, when the markets are doing poorly, sometimes you might find the dollar's leading. So let's look at the dollar, and we know the dollar's strong short term. You can see on a longer term basis, the dollar's come off these crazy swings from last March. Crazy swings. That is a 5-point range, which is 20% of the UUP ETF. I've never seen that happen before. We're halfway up. We're in the middle. If this was a stock, this would be my best buy of the week. UUP, it is a stock. It's an ETF. Weekly bongo's green. Mobile breakup from a squeeze. A new John Person buy signal. A kahuna. Only reason not to like this is it's starting to get extended from its moving averages. If the dollar looks good, what does that tell you about gold? Yeah, it's going to look poopy. Gold did not break out. In fact, it hit its chandelier stop and reversed. So gold is still sideways at best. I don't want to buy this until there's a clear-cut breakout. The VanEck, if I can find it, gold miners don't look any better. I hate this when it doesn't do an alphabetical. FANG, we'll look at here, broke down below the 200, the microsector FANG U. IBD 50, which you can expect does not look great either. If I can find it here, I'll take a look at that. God, I hate when this happens. Let me try this. What I hate when it happens is when it doesn't sort the way I want it to sort. So it's just me being a brat. And you can see biotech using the top-down analysis was right up at the top. Let me just hit this. I don't want to look at this again, but let's see if that's going to alphabetize them. Nope, it's just not going to be my friend today. Here's the IBD 50 ETF. Not good. So, great markets to be sitting on the sidelines, perhaps. Let's look at F7, number 7, the industry groups. Now, more potential reasons to be less bearish than I am is if we look at two-day force, we're off the mat, folks. We've got 42, two-day force down. We have only 15. So very short term, it looks like there's movement to the upside. Where is that movement coming from? Let's rank it by combo. Biotech, no surprise. I just told you about biotech. So Novavax, I mentioned, had a World Health Organization approval. I'm going to look at something we don't look at usually, which is market cap. Its market cap is 16 billion. That's not a lot, okay? Typically, a decent biotech that gets an approval in my world of cancer is worth 4 to 8. 16's high, but they're a real company with other vaccines as well. A U.S. approval takes this thing probably substantially higher and can certainly threaten these old highs at 300. I might consider getting back into Novavax now that it's got the initial approval. Moderna, let's look at its market cap. Remember 16 on the other guy? 118, 115 billion dollars, whatever that number is. It's so far away from me, I can't say, 119. So the other one's 16, and this is 119. Which one's a better buy? I think, well, Moderna's got a drug on the market. Novavax hasn't been approved by the US FDA. You're bouncing around the 200. You clear the 50. It might be interesting in here, but you've got also have a lot of overhead supply. But I don't think these guys are going anywhere. Grifols is a plasma company, don't know, or excuse me, GenFit rather, had a investment come in. And then here's the index. So most of the stocks are performing below the index. That Moderna looks good. Z-Lab is sort of evidence of what I'm seeing in this market. Does this look like a great buy to you? Yeah, it doesn't to me either, but I might buy it. Why? Look at the weekly to start, and you have a huge jackhammer here, okay, a reversal. You had a MOBO breakout, big candle here, a John Person buy, and two kahunas in a row. So I'm looking at this and saying, maybe we're done going down. I don't know how, I won't give it much of a leash. And the problem is, this was a big up move. But Z Labs looks interesting here. I know what they're doing fundamentally, and there are things to like about this company, which is a Chinese drug company, a $6 billion market cap. All right, so, but this is, you know, this is not the warm and fuzzy breakouts to new highs you feel good about. These you put on a very short leash because they can reverse and go down just as well. And catching a falling knife is bad. And, you know, maybe you should wait and let it go up there $5 or $10. But this is what I see. Look at CRISPR, another one. Not necessarily as bad, clearly higher highs and higher lows. Two kahunas in 3 or 4 days, mobile breakout from a squeeze. I like this as well. Arctis is another one breaking out above the 200. This is on my buy watch list. So there's some interesting looking biotechs, but boy, are they beating up stocks and not by any means would be considered market leaders. Specialty pharma, interesting. Nectar, probably not that interesting to me looking at it, although it was up. Bridge Bio, don't know anything about it, but a massive move on Friday. Kahunas, mobile breakouts from a squeeze. Guardant, one of the diagnostic testing companies. TG Therapeutics has just been a dog. So here's the problem. These are stocks that are moving. They've had a couple of big days with volume and price movement. They come to the top. They're going to go up someday. Is this the beginning? High risk. Entertainment properties, AMC, I don't care. I'm not going to look at it. Communication equipment. I've never gone after this guy, and it's probably to my detriment. But Arista Networks has been a monster from 94 to 138 in like a month. Pullback, looks like it's breaking out again. So that looks interesting. Cisco, quiet. So I'm just looking at the top 10 groups, internet-based services. Again, just like the biotechs, are these done going down? Uber, Zscaler, Bookings, Pinterest, Match, Spotify, Zillow, Expedia, Coupa, Wix. Every one of them is deep down in the pattern. Are they ready to run? Boy, they're extended to the downside and they're going to bounce. Here's one that had extended to the downside, 2 green candle lows, a pocket pivot volume. Yeah, they're all going to jump. That's the index. They're going to jump, but how far and when? Hard to go in early, although that's probably when the big money is made. Application software. Cerner being nibbled on by Oracle. I don't know what a fair price is, but it's probably getting up to where it's going to be. So it's probably too late to chase that. Here we go again. Zoom, DocuSign, Twilio, Autodesk, Apps, MongoDB. Well, this is probably the best so far because a break above the 50, there's nothing above it. But these are stocks that are all beaten down. Zendesk. I mean, some of these stocks are down 50% from their highs. I have a hard time jumping in. 5.9, great story on the way up. Not such a great story on the way down. Again, a lot to like here, but these are high-risk purchases and not what I like to buy. Other retailers, Carvana, really? It's in the midst of bingos. This just tells you how bad this market. Why did it make it to the force list? It made it to the force list because a 2-day return. Here was, it's interesting that it's even positive. But you could see on Friday, it was up 9.54% on a volume of 8 million, and the average volume is 1. That's why it made the list. And I'm not even going to talk about GameStop. Biofuels, everything's below the index, so we're not going to look at them. Number 9, life science equipment. These guys, many of these are involved in COVID testing or creating the molecular tests. But again, Illumina down in the bottom. Abbott, not so bad. Pays a 1.3% dividend. It's not that exciting. We used to consider this a persistent turtle. But of all the stocks I've shown you, the 8's above the 17, above the 50, above the 200. I just would have rather bought it here before it had its little bit of a run. Exact Sciences, QVital, again, another one that's broken above the moving averages. This thing is down from 286. It's more than 50%. Well, it fell down more than 50%. Is it running again? Well, it had its run up last, because of COVID. Maybe it's time to get back in. Parasite, no. Pacific Biosciences has great seasonality right now. Okay. In fact, let me just show you how I do that. So this is the QVital tool. So I'm going to type in here Pack B. See if it works. All right, so it's going to found Pacific Biosciences. Here it says it's too expensive. Here's a list of some of its peers. Here's its revenue growth. Here is its earnings, which are negative. Let's look at its seasonality. So Pack B, O. So what do I see? December, not that great, 55%. When it's up, yeah, it's not as impressive as I thought. Mixed seasonality. I guess something showed me it looked good over the next month, but this is Pacific PACB. A problem like this and the others, you're buying things way down in the pattern. That's not a growth stock purchaser. It's a bottom fisher, but maybe that's where we need to be. How about infrastructure? Fortinet, well, beautiful uptrend, sideways move. Are you breaking out here? Look at this, bottoming tails. Mobile breakout from a squeeze. Pocket pivot, massive volume, maybe. Something to watch. Palo Alto, similar. Okta down there, CrowdStrike got beat up. Then you get a bunch of stocks way below their averages. I have a hard time chasing those things. All right, so we've not found a lot of beautiful charts. I want to look at one beverage. Well, it's not going to be, yes it is. This one looks really interesting to me, but it's indicative of this market. And that is Sam Adams. So a couple things. It does have higher highs and higher lows. You had two kahunas back here giving a clear-cut buy signal. It's moved a lot. It's still way off its highs. The weekly bongos turned green. It's got a mobile breakout and a pocket pivot. Horrible relative strength. Well, look where it's at in the chart pattern. At some point, these stocks are going to start getting higher. It's bottom fishing. Is a falling knife that stopped falling? I don't know. That's the problem with this market, because most of the smaller stocks have done that. Now, let's just look very quickly at some of the leaders. Apple. Apple has pulled back some. Okay, it's still very high relative strength. It's still above the 17. And in my opinion, if this market rallies, this one goes with it. Microsoft. Microsoft is sitting right on the 50. Still has a relative strength of 90. But Microsoft has sold off a lot. How about Netflix? Broken. Not dead, just broken. How about Google? Broke down below the 50. How about Booking, Priceline? Ugly. How about Apple, Tesla? Broken down. So you look at some recent leaders and they're destroyed. Let's take that keepers list, which were great stocks at the time. These were stocks that you gave me of what you thought the best stocks in the market were. And I only wanted them if they hadn't broken down yet and they were true leaders. Here was our keepers list. Don't bother taking it down. Most of them are dead. Let's look at how they've come off. When we bought them, by definition, they were all at or near their 52-week highs. Zscaler's down 18, Blackstone's down 18, Netflix is down 17, AMD is down 16. The leaders have been shot. And one of the problems with keeping this list active is we don't know that the next generation is going to look like this. I can put the NASDAQ 100 just for grins. And this is going long. This is what happens when my wife goes to a play on Sunday afternoon and leaves me at home alone with a dog. And I got defeated in fantasy football, so I don't care about football anymore. Look at the NASDAQ 100. Peloton's down 75%. PDD 73. Baidu down 60. Zoom 55. DocuSign 50. I mean, I mean, it's crazy. The NASDAQ 100, 40 stocks are down less than 10%, 60 are down greater than 10%. See if I can make this work. Pause it for a second. Look at Friday in the NASDAQ. You had some stocks that really did well, like Cerner. And who is this? Zoom. But 64 stocks, 60% or more, 61 stocks out of 101 were decliners on Friday. This is on the NASDAQ 100. You can look at a heat map. A lot of red on the heat map. Yeah, Amazon was okay. Tesla bounced a little bit. Here's Microsoft, Apple. That's not a good thing when they're leading to the downside. These are all the watch lists. Let's just look at the S&P 500. Big guys, the generals have rolled over, friends. Banks have rolled over. This is not a great market. So now that I've hopefully convinced you to be careful, here's where I'm going to be looking this week. Although I'm looking to sit on my hands, I'm looking to sniff a little bit, but I'm not expecting to go out there and find a lot of things to buy. So I'm going to give you my explanation why each of these are on the list, and then I'm going to say goodbye. So, but I really don't know I'm buying anything. I'm going to be worrying about my contra ETFs and my positions. Switch, nice stair step move up. Mobo breakout from a squeeze on Wednesday, still in a squeeze. Pocket pivots, kahunas. John Person buy, took out the PSAR stop. Beautiful on the weekly. Not totally extended yet. Doesn't make money. Revenue growth, flat. Switch is on my list. You can see with demand over 1%, it's under some accumulation. So I like the pattern, although it's kind of loose. CubeSmart, sideways move, a REIT, so you expect this to do well in defensive times, pays a dividend, great earnings per share growth. I've got a target if it breaks above its chandelier stop. It had mobile breakout from a squeeze, person pivot, person buy signal, pocket pivot, kahuna. Commercial metals, I've already got Nucor, but here's another metal stock, steel stock. Why did I like it? Because it took out a chandelier stop. It had a bunch of pocket pivots and big volume. And it's got pretty good fundamentals. Fortinet, we already looked at. Certainly a leader, sitting right on the 50 with a lot of momentum. Expensive stock. Alcoa, time to buy was probably Wednesday or Thursday. It broke out this week. I'd wait for it to pull back some. Here's one of the biotechs. This one is actually already moving. It's above its moving averages. This is Inova. I've made money on this one in the past. Used to be in the 40s, I think. Let's see. Yeah, it must have been a long time ago. Yep. Then it sort of died. But right now, it looks like the pattern looks acceptable. You're buying it off the 50. Tight stops on everything. Nucor already mentioned, let it break above the chandelier stop if you want to join me in that trade. Don't really love the name Norton LifeLock, but pulled back to the 50 and broke out this week on Friday in a tough tape after a big bull flag pennant. That looks interesting. Virtu Finance, this is one that benefits if there's a lot of trading. It benefited a lot in the market turbulence last year. Breaking out here. Then there's a lot of biotechs. This is Arcus, pull back to the 50. Move above a chandelier stop. It would be interesting to me. AMD, I already mentioned. MGM, if the back to play comes back and the COVID stuff, the worry goes away. It's got great earnings per share growth. It hasn't made money yet, profit on the earnings side, so it's turning around there. It's got to move up some before I nibble, but a take out of the chandelier, I might start to consider it. Biohaven is another biotech that pulled back. Xenon is another biotech. Now, these are not horrible. They came back off their highs. Perhaps these are just complex pennant formations, and they're going to run again. That's why they're on my list. SITM is a technology play sitting on its 50. It had a beautiful run. It's a semiconductor with great earnings per share growth. Look at the SOX before you jump. Starbulk, I've been in and out of this. It's going sideways. Why do I have it here? Because I might be willing to say that it hasn't broken above below 18 and stayed there since May. And why does 18 matter? Because when you pay 11% dividend on a $20 stock, that means you're getting $2.20. So I love the dividend on this play. It's got great earnings per share growth. This was a great time to make money long. Now it's just going sideways. You buy it for the dividend. NextGen Healthcare is in the same family as Cerner, probably breaking out because a rising tide lifts all ships in that industry group. Cemex, is it done going down? I don't know that. But I got two kahunas in a row. John Person, buy signal. I got a mobile breakout from a squeeze. I've got, stock's been in a downtrend, but this one looks like it's ready to move. Leslie's Pools, I liked it because of the kahuna and the mobile breakout from the squeeze, and you're buying it off the low of the pattern. Not a great looking chart. Halozyme, this is one I talked about that showed up on Sager's tools. 3 kahunas in about 10 days. Relative strength going up. Sager had this as undervalued. Talked about Novavax. B&G Foods, sideways move. Why is it here? Because if it takes out the chandelier stop, it might be different this time. 2 kahunas in a row, pocket pivot, mobile breakout from a squeeze, 6% dividend is a real reason. And what happens if I'm wrong? My stop's right below the 200. I don't care. I care, but I'm not mirroring it. 5 and 9 is one of these application softwares, was a leader, probably wouldn't buy in until it starts a clear uptrend, but I want to watch it. That's why they call us a watch list. BioNTech, I could have put up Moderna, I did, Novavax. This one's sitting on the 50. This is Pfizer's partner. Quidel is one of the testing companies. Here's Moderna we looked at. Neogenomics, like Guardant Health, is a molecular testing company. Is it done? It's got a higher high and a higher low. So are we in a new trend? We could be. Had a mobile breakout, had a pocket pivot, kahuna, new John Person buy signal. Anything that you buy in the lower right quadrant here is high risk because of all the overhead supply. I like to watch. PTC Therapeutics, another biotech, beat up, some momentum's coming in. Shift for payments. Again, I'm watching these. Someday these are going to be interesting. Tons of overhead supply, not rushing out to buy them, but something's happening here. It's got positive divergence or convergence. It had out of a squeeze, new person buy, pocket pivot, and a kahuna. These are watches. They're not go out and buy me's. Copang, this thing is going sideways on the bottom, and then it had momentum come in Friday. Don't know anything about it. Here's SAMS. We already looked at that. Zeolab we looked at. And here's another cheaper biotech Turning Point, which I owned up near the top and got out. That's now going sideways on the bottom and a big move on Friday. It may be that biotech is coming up and you should buy an ETF, and that's probably the safest way. But look at the market, the relative strength improvement on this stock bouncing off the bottom. I just think biotech is coming back. I just don't know who the winners are going to be. No one does. Another one down on the bottom. Another one down on the bottom. These are stocks that have had big runs. They're showing stirring with mobile breakouts from a squeeze, bongo turning green, new person buy signals, kahuna, and positive convergence with relative strength. But you don't want to buy these or load up. You might want to speculate on one of them with tight stops. Now again, what do I do with these? It's simple. I have a large list of stocks that I'm interested in. And did I not turn on TradeStation today? Wow. Well, I could watch them in TradeStation. I could also watch them in Thinkorswim. And I could go into my Market Watch have a list of stocks that I just went over with you. And here I'm looking at unusual volume. Here I'm looking at, we call it the Vantage Point like indicator. It's not Vantage Point, they're not in Thinkorswim, but I have Vantage Point, and it turns out if they really use artificial intelligence, it's interesting because we can recreate their signals in Thinkorswim. But you didn't hear me say that, and I certainly wouldn't sell it to you or give it to you because it's a proprietary program. We just tried to duplicate it. Here is another short-term momentum signal that I have used for a number of years. You only get that when you buy one of my computers. Kahunas, high close and low close dojis, pocket pivots, Bible gap ups, and then I get into things like the daily RSY from Dr. K and some of his other signals. Here's one that looks interesting. Norton LifeLock. So why does this look interesting to me? It looks interesting because of this. It tells me that in the next 40 days, it has a 17% average return with a minimum of 8 years. So let's go look at that. Ignore the left-hand side for now, but look at the seasonality. So we talked about this being on my buy watch list. Look at the seasonality that's coming into this stock. Wow. Wow. Now, what would I do? Well, I think, to me, that technicals trump seasonality. But when seasonality is my friend and the technicals look good, I get excited. So, what was it, NLOC? I can't remember. If you saw my setup, you'd realize I'm projecting this on a 4K monitor that's on my wall, a TV screen, because my regular monitor is 8K, and it's so far away, sometimes I can't see all the writing. Norton LifeLock, technically, it looks great. You bounced off the 50, you took out your chandelier stock, mobile breakout from a squeeze, pocket pivot, kahuna. This looks interesting. Now let me just give you a gift. Let's pull up Seasonality Trader, and let's take a look at Seasonality Trader and see if Norton LifeLock looks any good on this, which really was the original version of Magenta, kind of like a divorce. So, seasonality, December 8th to January 14, there's only 2 years. So the season, what? You know what? This may be where the power of Dr. K's program, because Norton LifeLock is a merger. I've only got 2 years worth of data in Seasonality Trader, so that was not a gift. And it may be that there is more data, but you'd have had to manage the symbol correctly, which I don't think they do that they're up to date on that program at all with symbol changes. So I can't talk about seasonality on this. I can tell you that I know how this is set up, and to even print like that, you've got to have 8 years of seasonality. So they're using the former companies. I think Norton LifeLock looks really interesting. This is what it's projecting it's going to do. 28, down here to 24, 4. Do you get, do you get, see, he used to say go from here, 21 to the top, which is 28. If you can take that out, add that amount. So 7, does that get you up to 33? Kind of the same target that this is talking about. So I think Norton LifeLock looks interesting here, but let it take out this line before you go long. So on that note, I'm going to say have a wonderful holiday season. I have no idea if I'm doing this next week. I'll have Friday free, but the data sources don't always update until Saturday, and that I'm going to be with family. So, and plus, my Michigan Wolverines are playing on New Year's Eve, so who knows about the following week. But anyways, have a great holiday season. Be careful. I doubt if you were in cash right now, you'd wake up on January 15th and be too disappointed. That's not to say we can't have big moves up and down. I just, right now, this market feels like it's chopping away. Chopping with risk to the downside. Thank you. Oh, and I'll put the reference for Wally.